Welcome to The Explainer. So, what if I told you there's a single number that can give you a quick financial health check on a business? Like a real clue about whether it's going to make it through the next year. It's a fundamental tool, and today we're going to pull it apart and see exactly how it works.
Okay, let's just get this out of the way. One number? It sounds way too simple, right? Can it really tell you that much about a company's future? Well, look, it's not a crystal ball, but there is a surprisingly powerful tool that gives us a crucial first clue to answering that very question.
All right, to even start our investigation, we have to get our heads around one core concept: liquidity. Honestly, you can think of it as the financial lifeblood of a company. Understanding this one idea is absolutely key to everything else we're about to talk about.
At its heart, liquidity is actually super simple. It's all about how fast a company can get its hands on cash. And why does that matter so much? Well, because at the end of the day, you can only pay your rent, your suppliers, your employees with cold, hard cash. So liquidity is what keeps the lights on. It's the ultimate measure of whether a company can pay its bills right now.
So, how do we actually measure this whole liquidity thing? Well, there's one main tool that pretty much everyone uses. It's the most common liquidity ratio out there, and it's called the current ratio.
And this is it, the whole formula, right there. It looks simple because it is simple. All we're doing is comparing what a company owns in the short term with what it owes in the short term. Let's break down what those two pieces actually mean.
First up, on the top of that fraction, we've got current assets. Think of these as all the things that are either cash already or that the business expects to turn into cash within about a year. So yeah, this is the obvious stuff like cash in the bank, but it's also inventory sitting in a warehouse, waiting to be sold, and it includes something called accounts receivable, which is just a fancy way of saying money that customers owe them.
And on the other side of the equation, the bottom of the fraction, you have current liabilities. And just like it sounds, these are all the bills and the debts that the company has to pay off within that same one-year window. This could be money they owe to their suppliers, any short-term loans, or even the piece of a big long-term loan that's due this year.
So the most important word here, you've heard me say it a bunch, is current. Now in accounting, that's not a fuzzy term. It's a hard line in the sand. It means 12 months, not 13 months, not 11 and a half. We are looking at a very specific one-year window into the future for both what's coming in and what's going out.
Okay, perfect. We have the formula. We know what the pieces mean. But where do you actually find these numbers? You can't just make them up. For that, we have to go hunting in one of a company's main financial documents, the balance sheet.
Here's a really easy way to think about this. The income statement, which tells you about profit, that's like a movie. It shows you the story of how a company did over a period of time, like a whole year. But the balance sheet, that's a photograph. It's a snapshot of what a company owns and owes on one single day. And for our ratio, that snapshot is exactly what we need.
And check this out. This slide shows it perfectly. This is a simplified balance sheet. If you look, you can see the two numbers we're looking for, just sitting right there. I've highlighted them. Total current assets, $1,860,000, and right under it, total current liabilities, $1,270,000. All right, now for the fun part. Let's grab those two numbers we just found and plug them into our formula. Let's see what this company's financial photo is actually trying to tell us.
Okay, so we start with our total current assets. As we saw in the balance sheet, that's $1,860,000.
And we're going to divide that by our total current liabilities, which was $1,270,000.
You do the math and bang, there it is. Our key number, our primary clue, 1.46. That's the one number we'd been working towards. But, a number by itself is pretty useless. So what in the world does 1.46 even mean?
It's actually really intuitive once you see it this way. A ratio of 1.46 means that for every single dollar in bills that this company has to pay in the next year, it has $1.46 in short-term stuff ready to cover it. In other words, it can pay off all its upcoming debts with room to spare. Now, obviously, every industry is different, but there are some general rules of thumb. Generally speaking, any ratio above 1 is seen as pretty good. It just means you have more coming in than going out in the short term. A ratio of around 2 is often seen as really healthy, like a very safe spot to be. But a ratio below 1, that can be a red flag. It might mean the company is going to struggle to pay its bills on time.
So with our company's ratio of 1.46, it looks like they're doing okay. So case closed, right?
Well, not so fast. Just like any good detective knows, a single clue is never the whole story. This number isn't the final verdict. It's just the beginning of a real analysis.
I absolutely love this quote. The skill is termed ratio analysis and not ratio calculation. This gets to the heart of it. Anybody, and I mean anybody, can plug two numbers into a calculator. That's the easy part. The real skill is in the analysis. It's like a doctor doesn't just take your temperature and send you home. They analyze all your symptoms to figure out what's really going on. It's the exact same idea here.
Look, the current ratio is a fantastic starting point. It's fast, it's easy, and it tells you that business life is normal. But it has some big weaknesses. For one, it treats all assets the same. A dollar in cash is great, but what about a dollar with inventory? What if that inventory is a warehouse full of last year's trendy gadget that no one wants anymore? And on the other hand, a super high ratio, like say 20 or 30, that's not always great either. It could mean the company's just sitting on a giant pile of cash instead of investing it to actually grow.
So, as we wrap this up, this is the most important thing to remember. The current ratio is not an answer. It is a powerful question starter. It's that first clue that tells you where you need to start digging. If you see the ratio has dropped since last year, you now have a fantastic question to ask. Why? Are they having trouble selling stuff? Are customers taking forever to pay their bills? That is your real takeaway. The number isn't the story, it's the signpost that points you to where the real story is.